My name's Jodie. I'm from Northwest Accountancy. I'm the tax agent. My role is to educate and make tax easy. Today's video is about capital gains tax. So, what is capital gains tax? Generally speaking, capital gains tax is the tax you have to pay based on the sale of a piece of property or shares or some long-term investments. Now, unfortunately, capital gains is so complicated and there's so many to have different capital gains types of events. I'm really just going to focus on selling shares and selling properties in this example. So, selling properties or selling shares to make capital gains. Capital gains tax is the tax that you pay on selling an asset. Now, there's lots of myths and lots of different things that people say about capital gains tax, but the main way to calculate your capital gains tax is to work out what your cost base is. So your cost base is the original cost of what you paid for that product or for that asset. So when it comes to shares, you've paid a certain amount per share, sometimes just a dollar amount, but you've also probably paid brokerage fees as well. So that forms part of that cost base of those shares. When it comes to a property, your cost base is not just the contract price that you put on the contract to purchase it, but it's also the settlement fees, the costs to create the transactions. So any building inspections or any filing fees or any associated checks that your settlement agent might do, conveyancing fees, all of those things, even if you're paying for advertising, you won't pay for advertising, that's a selling cost. Anything that you're paying in order to get that property ready for you to buy. And so all of those costs, not just that top line of what you're offering as the contract, the biggest one that people forget or miss is stamp duty or transfer duty. So all of those costs come in to your cost base. Now, once you've worked out your cost base, then that's the amount that you've paid for that original asset. If you've done any improvements, so with shares, you might have bought some more shares in the form of dividend reinvestments. And if you did dividend reinvestments, then every time there was a dividend, you've taken that dividend money and purchased new shares. So that's a new cost to add to your cost base. In respect of property, if you've done any major improvements, so putting a new roof on, adding a pergola or a shed to the back, anything like that will form part of your cost base as well. Now, when it comes to working out how much tax you need to pay, we need that cost base, but we also need to know what your proceeds are going to be, or your proceeds were if you're working it out after it's happened. So what your proceeds are is what you've actually received from selling that asset. So in respect of shares, how much money actually went into your bank account, less those brokerage fees that you've paid. Nice and easy. When it comes to a property, we'll run through your settlement statement because not only is it the contract price, but we would need to reduce that by what you've paid for the agent to advertise and to as their commission for selling. And maybe you had to do some works to get it ready for sale, any fix-ups that might have come in the building report. So your cost base is how much you've paid for it, and then your proceeds are how much you've spent, how much you receive for it. So that then to work out what your capital gain total is the difference between the two. So your selling price less your cost price gives you a profit. And if you didn't make a profit, that's a capital loss, and you may be able to use that against capital profits either in the year that you sell or in the future. We can't claim a capital loss against your normal income. But with capital profit, so if you've made money, well done. If you've made money, then that is then taxed in the capital gains tax rules. So just working very simply with high-level numbers, if you've made a profit of $100,000, then if you've owned the asset for more than 1 year, then you're entitled to a 50% exemption. Now, I'm talking to individuals here, not companies. So just be aware there's different rules for different types of people, different types of taxpayers. So if you're entitled to a 50% exemption because you've owned the asset for more than a year, then instead of paying tax on $100,000, you then pay tax on $50,000. Then that $50,000 goes in on top of your other income on your tax return, and you're taxed at your tax rates. So depending on which tax bracket you're in, whether you're sitting at the 45% tax bracket, which is the top tax bracket for people who earn over $180,000, or whether you're sitting in a different bracket, you might pay tax at 37% or 32% or 19%. That income goes on top of your other income, and you're taxed based on your tax rate at the time. So worst case scenario, if you're the owner and you're the only owner and you made a $100,000 capital gain, you're taxed on $50,000. That goes on top of your other income. If you're taxed at the 45% tax bracket, then you'll pay tax of just under $24,000. You've made $100,000, you're paying tax at 24-ish. Capital gains tax is a little bit complicated because there's stuff in the past you need as well as stuff now that you need. But once we've got all of the information, it's really easy to calculate. So that's it for today's video. If you found it useful, please like, share, or comment if you'd like any other videos for me to record. Have a great day.